Tonight we have the great pleasure of having Dr. Barry Burns back with us, and he will share with us his professional trade timing strategies. Barry, welcome to the Candlestick Forum. We're anxious to hear what you have for us tonight.
Well, thank you, Becky. I appreciate that. Thank you very much. Let's see here. Whoops, there we go. All right, let's make sure that technology is serving us well. And okay, yes. Let's make sure everybody can hear me and also see the slide. If you would just type in a yes, a Y, a wow, that's an amazing slide, you're an incredible artist, or something to that effect. Okay, looks good. Okay, a little too loud. All right, I can do that. Absolutely. A little too loud. Absolutely very humble. No, just not too loud. Okay, very good. Thank you. All right, looks like we're good to go. All righty, so very good. Thank you so much to the good people over at Candlestick Trading Forum, especially Stephen Bigelow. Worked with him a little bit, love his stuff, really good, and just, wow, can't say enough good about him. So you guys are at a good place here, and I'm really happy that we're able to share back and forth to you know, broaden everybody's education. There's a lot of different ways to groom a cat, as they say, and I have trained under many, many different people myself over the years and always learned something from someone. So, you know, it's a business where you can continually learn and grow, and it's fun and exciting, and I'm passionate about it. My dad was a trader, so he was my first teacher. And gosh, he started me when I was 8 years old, and I'm turning 56 next week. I'm turning 56. Unbelievable. So that's a lot of years of trading. And so I have been around the block quite a few times, more than I care to remember. But first of all, let's just talk about a few things here. The first thing I want you to do is put your wallets and purses away. I'm not here to sell you anything today. In fact, I don't even have anything to sell you. So don't worry about that. I am going to be giving you something for free today, and that is one of the courses that I created. It's a little mini course, Trade Strategies of the Pros. And this is a course I just recently came out with. It's kind of a little correspondence course, 5 videos, and it's brand new, just updated a few months ago. So this is the latest and the greatest. It's not some old rehashed out-of-date info. And I'm going to give it to you for free today. So these little 5-minute videos, each one shares a different technique about how trading works today. I'm talking about in today's electronic markets, with the logarithmic trading going on, high-frequency trading, the masses of retailers having access to the markets, all that stuff intermixed, what's working now. That's what these videos are all about. And so each one is very simple, very clear, very concise, straight to the point, gives 3 to 5 simple steps for each one of the setups, and each video has a setup. So can look forward to that, and I'm happy to share it with you. I'm not going to go deep into my bio today. If you want, you can go to topdogtrading.com, which is my website, and you can read my whole bio there. But just so that you know that I have been around the block a bit, I've already told you my father, he was a trader, and he got me started. I created some courses for worldwide traders and Day Traders USA. Had many teachers and mentors over the years. Went out to Chicago, got an apartment, worked with a floor trader out there. And really, wow, that was a turning point in my career when I understood that the markets weren't really about the lines and the wiggles and the jiggles on our charts. They were about the people who were making the trades, the buying, the selling, not even just the bids and the asks, but the actual putting their money where their mouth is. And you got the feel of that, and you could see it when you're on the floor. And that was a real eye-opener for me. I've done chat rooms. I am a doctorate in hypnotherapy. I'm certified in neuro-linguistic programming, so I do help people with the psychology of trading. I've done training for traders through the CME, through the Eurex exchange, through various brokers, eSignal, NinjaTrader, Metastock. The list goes on and on and on. So been around the block a lot and still associated with a lot of those groups. I trade now. I started out as a stock trader because that's what my dad did. But then I moved into futures and options and Forex and commodities, and to this day I trade all of those markets. And started out more as a short-term investor, I would say. Then I moved into swing trading and day trading, and I do all three of those time frames now. So I'm a very flexible trader. I'm always looking for wherever the opportunities are in whatever markets and whatever time intervals. And what I do in my trading style is very adaptable and flexible to the different markets and the different time intervals. So let's talk about that. Today we're going to focus on timing. We're going to talk about cycles in the market, various types of cycles. But before I do that, I want to give you a quick overview of my trading method. And so here it is. It's very simple, so it won't take very long. In fact, what happened when I was in Chicago was I saw these guys making 4 and 5 figures a day. And when they showed me, they wouldn't show me too much of what they were doing. They'd show me a little bit. Of course, my mentor, he showed me exactly what he was doing because I paid him 2 truckloads of money to do it. But the other guys, you know, you're there. You could see what they're doing a little bit. But when we went out to the restaurants and then afterward to the bars, that's what really came out. So, but it wasn't so much the specifics of what they were doing that impressed me. What impressed me was how simple what they were doing was. It was so much more simple than what I had previously been doing and what most people I had seen were doing. And so I used to think to create more accuracy, a better win-loss ratio, a better risk-reward ratio, you had to add more things. The secret was to add things to your trading. And that is true to a certain extent, but then you hit the law of diminishing returns. And so I found out that actually simplifying my trading was very, very critical and helped me to keep a very clear mind so that I didn't experience mental overwhelm or confusion, and that's absolutely critical. And that leads to confidence, and that leads to being able to keep a cool head and ice in your veins when you're trading, especially day trading. And so I've simplified my trading down to what I'm going to share with you right now. I'm really only doing one thing. I'm totally a technical analyst. I'm a chart reader, and that's because, to me, technical analysis is the mathematics of mass psychology. And again, the markets move based on mass psychology, whether it's even people programmed a computer logarithm or whatever. They still use principles, basic beliefs that they have about the market, and they're going to have that program react based on those principles or those beliefs. So what I'm looking for on those charts is the mathematics of energy in the markets. Now that's why I don't follow the old SOS Bandit principles anymore. You know, that's long gone. People play, they game the bids and the asks now. I've actually sat next to traders who do that and watch them, and it's pretty useless as far as I can see now. In fact, it's worse than that. It can be deceiving. So I'm looking for where the money is actually committed. Like the old saying, put your money where your mouth is. I want to see where people are actually putting their money, where they're committing their money. That creates energies in the market, and the charts map those energies. And so that's what I'm doing. I'm defining energies in the charts. Now, on every single trade, there are 5 energies that I look for, and I look for them always in this order. My trading is very orderly. It's very rule-based. It's very objective. So when I look at a chart, I always look at these things in the exact same order. And the first thing I look at is trend. Now, I'm not necessarily a trend trader because trend is just one thing I consider, and sometimes I'll trade against the trend. But it's one aspect, and it is one of the energies, and it's the first energy I consider because it helps me determine which side of the market I'm looking to take, either the long or the short side. Then the second thing I look at is the energy of momentum. Now, trend is always a lagging indicator by definition, And I don't have time to go into why that is right now, but in my courses, when I teach people, I'm very adamant about explaining the whys of everything. It's very important. Everything has a market logic to it. I don't believe in just back testing and out of sample forward testing. Those things can be very helpful. Not saying they're wrong or bad. They're good. But ultimately, it's still curve fitting. And as every legal disclaimer will tell you, past performance is no indication of future results, and that's absolutely true. And also, we should not be trading with money that we can't afford to lose. We should only be trading with discretionary money. And I'm not going to be giving you any specific buy or sell signals here today because my job is to empower you to become a trader. I don't want you to be dependent upon me or anybody else. I want you to have that sense of empowerment. So that's what I do. When I teach people, I give you that power by teaching you why things work, not just trade when this line crosses that line or this pattern forms. But why does that pattern actually work? Why does it give you a probability scenario? So trend is always a lagging indicator. Momentum is a potentially, not always, but a potentially leading indicator. And that's when we look to trade it, is when it is a leading indicator, and we know when it is. So now that I'll give you a quick explanation of the energy of momentum inherently is a leading indicator. And just think of a locomotive going down the track. A locomotive has a lot of energy. You could pull the brake on that locomotive at any given time, and you can predict with pretty good certainty the future of that locomotive in the near future. It's going to keep going. If it's going east and you pull the brake, it's going to keep going east. And that's the sense that momentum is a leading indicator, in the sense that it's hard to stop momentum on a dime. So we don't know how far it'll go, but in trading terms, if we buy a low in an uptrend, we should be at least be able to get one more higher high. And so that's the sense, that's the logic behind the energy of momentum being a leading indicator. And then the third energy is the one that we'll focus on more today, which is cycles. And this is timing. And timing, most people think of it as buying lows and shorting highs. And you want to buy lows so that you're getting in at a wholesale price instead of retail. And that is one aspect of cycles, but we're going to talk about more today. Support resistance is the fourth energy. So I'm looking, what's the direction of the market? Do I want to buy or sell? Number two, is it a strong trend or a weak trend? See, this is where a lot of trend traders get messed up. If it's a weak trend, I don't want to buy it. I don't care if the trend is up. I'm not going to enter that trend because it's weak, and most likely right after I get in, it's going to fail. Now, if it's a weak trend, it actually might fade the trend, actually, because it'll catch a lot of amateurs in the wrong direction. The third thing, though, is then when do I enter that trend? And that's where cycles come in. When do I enter? And that's where a lot of people really struggle. Very few people I know who focus a lot on timing their entries with precision. And I'm very, very good at that. I've made that one of my specialties. And then, of course, we want to buy off support and short off of resistance. We use those as entries and also as profit targets. And then finally, the fifth and last energy I look for in every single trade is what I call the fractal energy. Now, that's just a fancy term for using multiple time frames. That's all that really means, so don't get caught up in the term fractal. And it's a very common practice to look at multiple time frames, but I do it a little differently than most people, and for good reason. The old orthodox approach doesn't work as good as it used to, given the nature of the markets today with all the computerized trading and the massive retail influence on the markets. So I measured the energy in the markets. For trends, I use a moving average. We need instruments. And instruments, or we call them indicators most of the time in technical analysis. I see, you don't need to know how to talk to trade well. I tell people English is my second language, and I don't have a first. But you need instruments to measure these energies, just like I've got a friend who has a little four-seater airplane, and he'll fly me over to Catalina Island, and he's been flying for decades, and he's very experienced. He can look out the window of the cockpit, and he can pretty much tell his altitude and the angle, of the plane from tip to tip and tail to nose and all that kind of stuff. But then he's got gauges or instruments, and those will tell him exactly what the tilt of the plane is, exactly what the altitude is, exactly what the speed is. And that's how I look at indicators. They don't call them money makers for a good reason, because they don't make you money. Some people say, well, they don't work, and that's not literally true. Indicators work for the purpose that they were designed. They're simply mathematical formulas. You have inputs that go in one end, and a value comes out the other, and in that sense, they work. That value is right. But then we got to translate that to making money, and that's a whole different thing. So how I use them is not directly to make money, but instead directly to tell me what each one of these energies are, to give me a value for each one of these 5 energies. So I use a momentum indicator, I use an oscillator for cycles, I support resistance, we use all kinds of things, previous wave highs and lows, floor creator pivots, Fibonacci levels, and for fractals I'm generally using a chart that's 3 times that of the setup chart interval. Now, the whole reason we're doing this is to determine a probability scenario. And the way to do that is very simple. At each time I'm looking to potentially take a trade, I only ask myself one question. How many of those 5 energies are aligned, all saying buy or all saying sell? And then I give each setup a score of 1 to 5, depending on how many of those energies are aligned saying buy or sell. So obviously the higher the score, the higher I consider the probability of success. I liken it to taking a trade to court. In other words, I need 5 independent witnesses to establish a preponderance of the evidence. Now, the operative word here is independent. So in other words, if I were to put 5 trend indicators on the chart, that would not work. That would not give me a probability scenario, because really I would just be measuring one energy with 5 different instruments. So the reason this approach gives you a probability scenario is because you're measuring 5 independent energies. In other words, each of these 5 energies is uncorrelated to the other 4. So when all 5 agree, then it's significant. And that's what gives us a probability scenario, because we don't trust any one of these indicators at all. 0, zippo, nilch. But when 5 totally uncorrelated energies agree, okay, still no certainty. There's never any certainty in trading. Trading, no matter how good you are, always involves risk, which is why we employ money management, risk management, and hedging. But still, now we have a probability scenario that favors us. All right, so let's move on. That's my method. You now learned the 5 energy method, basically. But today we're going to focus on that number 3. And the reason I wanted to give you the overview is so that you can see that cycles are just one part of the methodology, that we can't trade on cycles alone. And this is basically what the guys in Chicago who are doing well, which, by the way, was still not most of them. Just because they're a floor trader doesn't mean they're making money. Just because they have a logarithmic trading program does not mean they're making money. So most of them still don't. And then we would go to the bars and the restaurants. I live in Los Angeles. And here you go to the bar and the restaurant and everybody's an actor or an actress, right? In Chicago, everybody was a floor trader. Or a former floor trader. So it's pretty interesting, at least in the financial districts. So you need a number of variables, uncorrelated variables, to establish a probability scenario. And I use the number 5. Beyond that, it starts to get too complicated. You actually filter out some otherwise good trades because you're demanding too much of a market that always has an element of noise and messiness to it. And you also get, as I said earlier, the law of diminishing returns. So today, though, we're going to focus on cycles. Now, a chart has 2 dimensions, the time axis on the bottom and the price axis along the right side. However, even though there's only 2 dimensions, most traders with whatever they're doing, whether it's price action or indicators or whatever, they're only using time. We're derivatives of time, or I'm sorry, price. We're derivatives of price. So they're only using 50% of the chart. And how can you have a probability scenario when you're only using 50% of the information available? So a common lament is, well, the market looked like it was going up, so I bought, and I got filled. Then the market turned down against me right away. I got stepped out. Then right after I got stepped out, the market turned back up in the original direction of my trade and made a major move. Why does that happen? It happens because they don't know how to time their entries with precision. And in fact, one of my mentors used to say that. He said, retailers are usually right, but at the wrong time. And that's exactly what he meant by that. There it is. Retailers are often right, but at the wrong time. Timing is something that people neglect to their own doom. Now, not only does a chart only have two dimensions, but the famous trader W.D. Gant said of the two, time is actually more important than price. Now, there's many different types of cycles. So the one we think of most of is just the oscillations the market makes as it moves up and it moves down. But we're going to look at some others today. We're going to look at seasonal or calendar cycles, very well known. We're going to look at volatility cycles, very exciting to trade those. We're going to look at order chaos cycles, something that you won't hear about elsewhere, or at least not very much. And then coupling and uncoupling cycles. And then finally, the up-down cycles, or the oscillations in the market, the most well-known type of cycle. All right, so we're going to look at each of those briefly today. So let's start with the first one, seasonal or calendar cycles. So these are longer-term cycles that do occur on a regular basis based on the calendar, obviously. So one of the most obvious is the agricultural markets. So if you're investing in soft commodities, or you're investing in a company, a stock that is involved in the agricultural industry, this is one to pay attention to. And it basically goes around the farming cycle where they sow in the spring and they harvest in the fall. Another calendar cycle or seasonal cycle is the retail sector. So right around the end of the year with the holidays, there's a lot of retail companies that make most, and some even all, of their profits during that time of the year. And so any particular companies associated with retail, that's something that should be considered when investing in those stocks. The travel industry is another one. People do more traveling in the summer and during holidays than they do at the other times of the year. So if you're investing or trading those type of stocks, keep that in mind. Now, here's the tricky part. It sounds great. Oh, well, I just buy the ags in the spring and I'll sell them in the fall. And of course, nothing can ever be that easy, and it's not that easy because the cycles are not that consistent. In fact, I learned cycles from one of the great cycle masters, and he would say cycles expand and contract, and sometimes the market even skips cycles. And sometimes they even get what he called an inverted cycle. And it's true, all those things do happen. So think of these types of cycles like just these three. There's more than these three types of calendar cycles, but think of these as the meta pattern, the norm. But there's always going to be outliers, there's always going to be exceptions. And even these patterns are not always perfectly consistent. So therefore, you can't just trade a calendar, you still have to learn to read a chart. So you come to the chart with this information, and then around these times you start looking at the chart to see what's going to happen if the meta pattern holds up. And then remember, again, this is only one of the 5 energies. Therefore, we do not trade on cycles alone. All right. Now, one of the most famous calendar cycles is what's often called the Halloween cycle or Halloween indicator, where around the end of October, early November, they say that's the best time to buy, and then it may go away. And most of us have probably heard of that. And historically, if you go back decades and decades and decades and decades and decades and decades, yes, statistically that has held up nicely. But again, just as an example of how it doesn't always, it doesn't always. And so, for example, if we go back here, this is the end of 2007, November, and we're up here. So if you bought here and then you went away in May, well, that time it didn't work so well, that year. Okay, then you get out of the market in May, be right around here somewhere. And typically what they say to do is then take your money out of equities and put it into something else, bonds or something that's an income source during this time, and just wait. And you get your small interest rate or whatever. These days, puny interest rates. And that would have been good because you would have avoided this downfall here, this drawdown, this not technically a drawdown, but this bearish market here. So that would have saved you that loss. Then you come back in November, okay, early November, and then you get out in May. Well, that's pretty much a wash, made no money. Then if you got out in May, well, then in November, when you got back in, well, again, now you lost opportunity there. That was an opportunity lost because the market actually turned to be bullish during that time. So just an example of how you need to learn to read charts and not just trade the calendar. Okay, the next cycle. Oh, by the way, one last thing I'll say on that too. If these things happen, Dow theory is something that you should all be aware of. And one of the aspects of Dow theory, one of the principles, is called discounting the market. So discounting the market means that the professionals, they don't trade at the time of this beginning of these seasons, whatever the season is. They trade far in advance of it in anticipation. That's called discounting. It's similar to the principle of buy the rumor and sell the news. So by the time, in fact, you've probably seen market or stock will come out with good news and it'll tank, it'll go down. Because the play was already done by the pros. And if the market, if it comes out about average of what they expected, well, it's done. It's over. The play's done. A little better, maybe it'll go up a little bit. And if it's worse, well, then that's really bad. And sometimes the market will go up on bad news. And this is all because of timing. Again, retailers are always behind the ball on timing. Professionals are trading in advance and in anticipation of these things. And so don't wait until the calendar starts. It's when we go into the Christmas season, same thing happens. If you watch Bloomberg or CNBC or any of the investment channels, they're always talking about the Christmas season in September, right? And we start seeing Christmas decorations and everything. Well, yeah, because that's when they're trying to anticipate whether it's going to be a good Christmas or not, because that's when a lot of retailers make most or all of their money. They don't wait until it's announced what were their Christmas sales afterwards. The deal's done, the game's over. Okay, so let's move on to volatility cycles. It's another type of cycle. I call this the ex-con pattern, and that stands for expansion, contraction. And this has to do with the range that the market will move in a set period of time. Will the market be in a very narrow range, or will it be in a big range? And by the way, volatility is separate from trending. A wide volatility range, or a big volatility market, high volatility market, I should say, can be trendless. Can be trendless. So they can be challenging to trade. Don't think that, and sometimes people think, oh, the best trending market to trade is a high volatility one. No, it is not. It's very challenging to trade a high volatility trending market. The easiest trending markets are the ones that are the low volatility because you can place tighter stops and stay with it easier emotionally. It's much easier to stay with the trend. Now, having said that, most people trade volatility cycles backward. So what they'll typically do, they'll look for things like Bollinger Band squeezes or triangles, or whatever, typical contraction patterns. And or they'll do the opposite. A lot of people like to get into high volatility markets because they're moving. right? We like to be in markets that are moving because we can only make as much money as the market moves. So, options aside, obviously. So they'll use a scanner, and they'll scan for high volatility markets to trade, thinking that, well, these are the markets that are really moving. I want to be in the markets that are moving. The problem with that is, again, timing. Their timing is off because they don't understand that there's a cycle to volatility. So by the time the markets have been in a volatility pattern long enough to show up on the scans, for there to be enough data to calculate on the scan, it quite often is just getting toward the end of a high volatility cycle and ready to go into a low volatility cycle, and right before contraction sets in. And so people often wonder, again, dang, I got into this market, it was high volatility, how come every time I get in, then all of a sudden the market goes flat? And they think, oh, their broker's trading against them, or somebody's, watching their little $5,000 account. No, it's just simply that they're not aware of volatility cycles and how to trade them. So what I like to do is I like to trade what I call inside of contraction. I love to trade triangles, for example. Bollinger Band squeezes are great too. But I don't wait for the breakout like a lot of traders do. I trade inside the contraction, inside while it's still contracting, because that's when I want to get in. Again, a hallmark of professional trading against amateur trading is the pros get in before the amateurs. And over and over and over and over again, the retailers are always late to the party. So I like to trade inside of the contraction. And plus, breakout trading these days, there's just so many fake outs, so many false breakouts. And I've got friends who trade breakouts and they do it well, so I'm not saying it can't be done. It absolutely can be done successfully. But it just doesn't fit my personality. I like to get in earlier. This is how I like to do it. So again, triangles, Bollinger Band squeezes, wedges, these kind of things, I love trading them. I love it. Now, if you're a day trader, and I day trade pretty much every day, as well as swing trading and my long-term investing in my retirement accounts. But here's a meta pattern that we see most days. Now again, not every day, there's exceptions to this, but every day has a meta pattern of this volatility cycle. And it's well known, high volatility in the morning, more contraction or low volatility in the middle of the day, and then high volatility again in the afternoon. Now, just by the time everybody gets to know something, it stops working. So when I was in Chicago, I would sit there, and one of the advantages of being on the floor is you can look around and you can see the people. Who's still there? Are the major traders of Goldman still there? Merrill? Are these guys still there, or did they turn it over to their flunkies? And basically the flunky is told, don't do any damage, don't do anything. Just kind of keep the status quo. That's their job. All the other guys are off having their drinks. Now, there will be times when I've seen they'll leave at early in the morning. They'll come in, they'll trade for an hour, they go. It's like, well, all the whales are gone. Not much is going to happen, most likely. Other times, they'll stay through lunch. And those are very interesting times to note, because then you're probably going to get some action during lunchtime when everybody thinks, oh, it's going to be quiet. Yeah, the meta pattern's there, but watch day by day by day. The whales are there. Then there's going to be some big waves made. So watch for those times. Those are very, very powerful times to make money. Now here's a cycle that you won't hear about too often. I call it the order chaos cycle. In fact, I was just meeting with a guy who's a financial planner yesterday. He's not my financial planner. I was just talking with him. We had lunch together. Very interesting man, very intelligent man, extremely intelligent. And he believes the market is a total random walk. And of course, he's read the book Random Walk Down Wall Street, like a lot of us have. And this is held by a lot of people, that everything that can be known about the market's already been factored into the price of the market, and therefore no accurate predictions can be made out into the future. Very, very convincing argument. And there's a lot of truth to it. Then there's another whole school of thought, which is to the other extreme. And the other extreme says, oh no, the market is perfectly orderly and predictable and works on the basics of mathematics and geometry, and you'll even hear some people say, hey, I've predicted the market 10 years out into the future where the Dow would be at the exact price and the exact time. So, and sometimes people have done that. Sometimes people have made amazing predictions. And I've studied both of those sides, and they're both pretty convincing, but obviously they're diametrically opposed to each other. So I started thinking about it, and I thought, well, obviously they can't both be true, so what's going on here? Why do I see the validity of both? And then it occurred to me, both views continue to have followers. Neither one has been completely discredited. Why? Because they both do have merit at different times. Sometimes, in fact, I would even say most of the time, the market is a random walk. It's very chaotic, it's unpredictable. But there are certain times when the market becomes orderly. And those are usually times when professionals get involved, they start their accumulation, because professionals, they bring in big money, and they bring it in piecemeal. They don't bring it in all at once, otherwise they'll raise the price and they don't want to have to keep buying at higher prices. So you start watching the accumulation, you watch the block trades, and they'll bring it in through different avenues. So you can't just watch, well, who's bringing the money in, because they're going to hide it intentionally, obviously. But you start to see the patterns, and this is what creates trends and creates stages or waves, if you will. And when the market becomes orderly like that, then again, there's no certainty, but there is high probability opportunities for trading. And those are the times we wait for. Now, this is why overtrading is the cardinal sin. Because, and maybe you've experienced this, a lot of traders will experience a situation where they'll be making money for a while with a certain trading system, whatever it is, and they think, oh my gosh, I made money all week long, I'm doing great, I'm incredible, I'm amazing, I'm God's gift to the trading world. And then the next week, the next month, whatever, all of a sudden they give it all back and more. Why is that such a common experience? Again, it's because the market moves in cycles, and they're making money during the orderly market structure, and then they're giving it all back when the market goes back into a random structure. But they're not aware of these cycles in order to know when to trade and when to keep their powder dry. So this is really the foundation of waiting for the alignment of the 5 energies. People ask, well, how do I know when we're in an orderly cycle? When the 5 energies align. That's when we have a high probability of being in an orderly cycle, where the market will move in an orderly fashion. Okay, the next, the 4th cycle is also a fairly well-known one, especially among investors. And this is good for investing. Really, it's good for everybody, you know. Coupling and uncoupling cycles. What this means is we look at sectors, industries, countries, currencies, commodities, interest rates. That's why I said, you know, I trade all these different instruments because I'm always looking for opportunities. Now, there'll be times when these instruments will trade in a similar fashion, a similar pattern. They'll be bullish at the same time, they'll be bearish at the same time, with the primary equity indexes, let's say the S&P or the Dow, or the NASDAQ for that matter. But then there'll be other times when all of a sudden one of these markets starts to veer off and uncouple from whatever benchmark you want to use. You can use different benchmarks. The most common one is the S&P. Now, when that uncouples, there's an opportunity there. There's an opportunity. Again, you want to get in early when that uncoupling first shows. When one market's going up and the other one's going down. Usually there's something that happened that has created this in the economy, and it will, not always, but normally there will be a sustained reaction. And money can be made from that. Now, of course, again, we're always reading the chart. We're always managing our risk, doing our money management, and doing our hedging to to just make sure that we keep ourselves safe. But these cycles do provide key opportunities. And again, the key is to catch the uncoupling early. So the way I do it is I have a way of mapping relative strength. This is also, by the way, you can do this another way. Instead of looking for uncoupling, you can use this as a potential way of trying to outperform the benchmark, the S&P 500. Look for sectors and industries and so forth that are outperforming your benchmark on a relative strength basis. And finally, the last cycle we'll talk about today, by the way, this is not an exhaustive list, this is just the 5 that we're talking about today, is the up-down cycles, or the oscillations that markets make. When we're in an uptrend, higher highs, higher lows. We're in a downtrend, lower highs and lower lows. Now, there's a thing called right and left translation, and it's very big in cycles. So what that basically means is markets tend to make bigger price moves and spend more time. Notice we're talking about both price and time. See, when most people talk about uptrends, they're only talking about higher highs and higher lows. That's not enough. Also, look, how much time are we spent moving up as opposed in the correction phase? And that's for an uptrend, obviously, and smaller price moves down and spend less time on the correction. That, again, is the meta pattern that we're always looking at. Now, so that's very well known. Now, here's what you really want to do. You want to combine the up-down cycles with volatility cycles that expand and contract. This is actually how I trade inside of contraction. Inside of contraction, I'm looking for these oscillations, and we have a way of determining which way the market is likely to break out. And then if it indicates it's going to break out to the upside, then I'm going to be buying the cycle lows inside of contraction. Very, very small risk when we do that because of the contraction market. The range of the bars tend to be very, very small. We also use the up-down cycles in combination with the order chaos cycles. So again, we use these up-down cycles in combination with every one of these other types of cycles. And also with the calendar cycles, obviously, to really provide precision timing. The up-down cycles are used on the microcosm to get us into these other cycles which tend to last longer, be more macro cycles. So here's an example of up-down cycles, what I was talking about. Here's an uptrend. So we've got price range is measured by the right side of the chart. Goes up, covers more range going up than it does moving down. And that's simply measured by a higher high and a higher low. But then look at how much time it's spent coming down. Not very much. You can also do that with bar counting if you're using a time-based bar. Now, this particular chart is a tick chart, and therefore that doesn't work. You would have to actually measure time and not just count bars. Moving up, again, lots of time going up, very little time coming down, wide range going up. Here's another example of your up-down cycles. Cycles are the rhythm of the market. It's very interesting, actually, when you really get into the deep aspects of mapping markets, which is really what charting is. Charts reflect human nature in so many ways. In fact, I have a whole webinar that does just that, talks about that exact fact. We can't get into all that today because of our limited time, and we're just about done here to get to our Q&A session. But with up-down cycles, what we're talking about is the rhythm of the market. It's almost like the inhale and exhale, the respiration of the market. And just like human beings inhale and exhale. So we have a rhythm here. It goes up, and we're looking to have a cycle oscillator here. And we go down. We go up, we go down. We go up, we go down. We go up, we go down. And there's that respiration, that rhythm, just like we all have our heartbeat. We all have our respiration and so forth, everything. And why does that happen? Why does that happen? It happens because it's people who trade the markets. So our nature is actually reflected in the markets. Now, again, just as a little reminder, cycles are great, but they can't be traded alone. So for example, here, cycle indicator, there's a cycle low, there's a cycle high. That is a cycle low, that is a cycle high. Would I want to buy this? No way. Why not? Well, there's not enough range. It doesn't go far enough. If I did buy it, I wouldn't be hurt terribly, but I don't want to. I want to trade a direction that's going to move a lot. So cycles are great at indicating timing, but you don't want to trade every cycle high and so low because they don't indicate range. What's range indicated by? The energy of momentum. So this is why we have to use all 5 energies in order to actually make money and put together a method that is profitable. So we'll just finish up here. High probability trading, everything works sometimes. You can try any method and it might work on any particular given day, any given Sunday. Nothing works all the time. So you're going to have losses. Trading is there's never any certainty in trading. But there are probabilities. And that's what we're trading. We're trading probabilities. So with our money on the line, we want to know, is there a high probability it will work on this particular trade? And if there is, we take it. And if there isn't, then we stand to the sidelines and we wait for the next one that is a high probability trade. And that's defined by waiting for the alignment of the 5 energies to put the odds on our side. And again, here it is just for your review. My whole method is basically 5 steps. Number 1, looking for the energy of trend. Number 2, a trend that is strong, only trading strong trends, not weak trends. And that's measured by momentum. Then, if we have those 2, then we wait for the right time to enter. We don't want to be caught in an ABC complex retrace down and enter at A. We want to enter at C. We're going to get the lowest low during the correction. And we can do that with amazing accuracy. Support at our back. In other words, if we're buying, we want to buy off of a support level. And then finally confirmed by the next higher time frame. And that's using multiple time frames. I never trade without that. The next higher time frame must always, always, always have that energy. I use it as a filter to keep me out of otherwise good-looking setups. So here's just a quick example. This, I think, is the second to last slide. But here's how it looks on a chart, just so you can kind of see and visualize it, since charts are so visual. So here's my trend indicator, the red line. It's angling down. I got a 2-minute chart on the left, a 6-minute chart on the right. And so we're looking to go short. All right, so that's energy number 1. 2, we're holding support. That's the 15 EMA. Actually, it's resistance because it's above us. So that's good. We've got something to bounce off of after we've gone up a little bit, had a little correction against the downtrend. Number 3, there's a cycle high here, and it's turned over. So timing, yes, this is the time to get in. Number 4, momentum. Now, here's my momentum indicator. And for shorts, on the retrace up, I want to make sure it holds below the 0 line. See, there's the 0 line. If it goes up to the 0 line, that means momentum has come out of the market. I want downward momentum from going short. It has stayed below the 0 line, and therefore there's still momentum going down. The strength is down. And then finally, I go to my next higher time frame, the fractal energy over here. And what I do is I don't trade in the direction of trend of the longer time frame. I trade in the direction of momentum of the longer time frame. And I have to have that. And again, it's angling down. That's all I need. And therefore, I got a 5 out of 5 trade, and I'll take that every time. Very robust, very adaptable. As I said before, I use this for stocks, commodities, options, currencies, futures, investing, swing trading, day trading, because we're just putting these instruments on a chart, and then those instruments will tell you whatever the energies are on that market on that interval. So it's very simple, very objective, pretty much counting to 5. Okay, in my trading plan, of course, I've got a complete trading plan that goes into more detail than this, obviously. And we include psychology in there, little biofeedback stuff, scorecards, you can count your 5 energies, complete trading method. But here is the last slide, and then I'll take questions. If you want to reach me, if you have any questions that you don't want to ask publicly here or we run out of time, feel free to send me an email at barry@topdogtrading.com. There's my email address. That'll come directly to me. Also, I promised you my free 5-day video correspondence course. This does include 5 days of video instruction. Also, I forgot to mention this. Yeah, in the videos, I'm also going to send you a bonus video, a 6th video, that gives you I call it my rubber band trade. It's one of my very favorite trades. I take this trade every time it sets up. Super high win-loss ratio. Now, it's just a scalping trade, but the win-loss ratio is fantastic. And I'm going to send that to you in a video, and no charge for that. Feel free to use it, make money with it, and God bless you and the horse you rode in on. So that's another extra thing that's in there too. And then next Tuesday, I showed you my timing indicator briefly. Well, there's a lot more to that. And so if you want to get onto the webinar next Tuesday, I'm going to be doing a special webinar where I'm giving away that timing indicator. And you can use it on pretty much any charting platform I've ever seen. I'm giving it to you, and I'm going to hold a tutorial on how to trade it. So not only do you get the indicator itself, but you also get instruction on how to trade it, the techniques that I use to trade it, how to know when it's a good signal and when it's not. And again, that's a free webinar, and the indicator is free, and the training is free. That'll be next Tuesday. So if you want all of that, including information about the webinar, just go to that website that you see there, topdogtrading.com.bigelow.html, and make sure you put the .html in there. Just fill out the form, and everything will come to you automatically via email. You should get the first video today. All right. Well, I went a little longer than I had planned, but that's okay. Now, let's see what kind of questions we have here and how many I can answer before we run out of time. Thank you, by the way, everybody. I just want to thank you for being here and for participating. I trust you got a lot out of this. This is really good, valuable information, and I hope you can use it, and I wish you all the best. So anyway, let's see. Okay. So James asked, well, okay, so he asked about the cycle indicator. Yes, it can be used with NinjaTrader, and like I said, it's a customized indicator, so I'll give it to you on Tuesday's webinar if you come to that. Let's see. Okay. All right, let's see here. Again, the momentum indicator Carl's asking about. Again, that's unfortunately more than I have time to go into right now. I'm kind of limited to answering brief questions because of our time limitations right now. But yeah, that is available in one of my courses, obviously. Gordon, does your method identify a price level on which to get in? Oh, absolutely. To the exact penny or tick or pip. Yeah, and my stops, same thing. My stops are identified to the exact penny, pip, or tick. And I keep my stops very small. My stops are puny, but oh yeah, absolutely. There's a precise price you get in every single time. There's no guesswork to that at all. Very objective, very rule-based. Can it also be in a chart format? Yeah. Absolutely. Do you see pivot points when price closes outside? Do you see pivot points when price closes outside? I'm not really sure what you're asking there. John, okay, the webinar registration link will be emailed to you if you go to that website, TopDogTrading. Oh, you know what? There's an error on that website URL, I think. Yeah. I'm sorry, it should be topdogtrading.com/bigelow.html. Ooh, I just caught that. See if I can plug it in here. www.topdogtrading.com / goes. Why is this not typing in here right now? Oh, I'll try. Big, there we go. Well, I guess I was typing too fast for it. There it goes. Okay. Topdogtrading.com / bigelow.html. Ah, thank you for catching that. Yes. Yes. I made a mistake, forgot the .com in there. Okay, so make sure you do that one. There we go. That one down there. That's the right one. So anyway, you'll get the registration link when you go there and fill out the form. Ooh, that was close. Some of you would have figured it out, I'm sure. Thank you, Becky. Yeah, Becky typed it into the, thank you, Larry. Appreciate that. Yeah, but Becky typed it in, and it's I think that's a clickable link, so you can just click on that link there, and that should work. Let me know if it doesn't. Okay, let's see. Wow, we got so much. Do I see pivot points when price closes outside of Bollinger Bands? Sure. Yeah. Let me see if I can get the link to work here for me. Yep. Okay. The link worked for me. So that link does work. If you just click on Becky's link there, that does work. Yes. Harry, the videos you can watch at any time. Yeah, the 5 videos. Now the webinar on Tuesday, that will be at 8:30 Eastern Time p.m. 8:30 p.m. Eastern Time on next Tuesday. Rod asks about tick charts versus time charts. You know, they have their advantages and disadvantages, each one. So I like tick charts, but time charts have some advantages. For candlesticks, I think time-based charts are better. But you know what? In fact, I wrote an article about that a few years ago. If you want, send me an email at barry@topdogtrading.com. In fact, anybody who'd like that article. And I wrote an article specifically about the advantages and disadvantages of time bars versus tick bars. And I spelled them out there for you. So free article. It's on my blog, actually, but I don't remember the URL because it's been several years, so I'll have to look it up. But send me an email and ask for it. I'll look it up and I'll send it to you. Yes. Okay. You're very welcome, Harry. Okay, how are we doing time-wise? Okay, we got like 2 minutes left. Let's see. I'm looking for any. Got a lot of questions here, way too many for me to answer. So I'm looking for any that I think would be of interest to most people here. Because I missed a bunch while I was talking. People asked some questions, and I wasn't even looking at that time. Yeah, there's going to be a recording. I believe Becky and the people over there will send that out. Let's see. Yeah, accumulation, accumulation and distribution is a very good thing to look for as well. I like to look at that as well. So I do. That's excellent. I don't use any particular reports or newsletters. I'm going through and just answering some questions here as fast as I can before our time runs out. So no, I don't really look at any particular newsletters, reports, any of that kind of stuff. Used to, but I just don't really need them anymore for myself. Let's see. Okay, I've answered those, There are some repeat questions here. There's a lot of thank you. Yeah, any questions? Nora asked me what I consider a small chart. And there's been several questions that have come in regarding time intervals, what time intervals I trade, and so forth. Again, I have an article on that, and I have a very definite answer to that question, but it's a little lengthy. A lot of people assume, oh, there's a certain time interval that's just the best, that is the best to trade. And I don't believe that. I believe time interval, which time interval you should trade, depends on various factors. Just to give you a quick idea, since so many people ask that question, I'll give that one a little more time. Number one is my stops are defined by the range of the bars. I'm buying cycle lows, I'm shorting cycle highs, and so my stops are placed based on the range of the bars, how much money I'll be risking on that trade. So therefore, shorter term charts, you have more narrow range bars. Longer term charts, you have wider range bars, of course. And so therefore, the time interval you use has a lot to do with the size of your trading account, because you heard me reference money management. I don't like to risk more than 2% of my trading account on any one given trade. In fact, I won't do it. Not only don't I like to, I won't do it. It's one of my hard and fast rules. So therefore, you need to look at your trading account, look at the average risk that would be taken on a cycle high or cycle low, and make sure that your time interval allows you to get on most of those cycle highs and lows with a risk of 2% or less of your trading account, number one. Number two is kind of a psychological thing, a mental thing. How fast are you at making decisions? Real short-term charts, you would have to make a decision quickly because the bars are going by fast. Longer-term charts, you have more time to consider, to examine and evaluate the setup, the indicators, etc. So how much time do you need to make a decision? That answer varies from person to person. Some people can make quick snap decisions. Others, they just feel like they need more time. Just to give you a couple of ideas, we'll have some concrete examples, but this is just me, and what I do does not mean that's what you should do. But like, for example, the E-minis is a very common market, so I'll address that. When I trade the E-minis, I use a 1,000 tick chart for my setup chart and a 3,000 tick chart for my confirmation chart. Now, when I trade the NASDAQ 100 E-minis, the NQs, then I will use a 200 tick chart for my setup chart and a 600 tick chart for my confirmation chart or my fractal chart. And part of that has to do also with, and there's another factor, the volume. How much volume does the market trade? That's another factor that is taken into consideration when determining the time interval to trade. So, and then obviously for longer trades, I always am looking at daily charts and weekly charts. Okay, so we should be done here. Carlos asks if I consider trading the open range. I do not. I know a lot of people who do, and that can be done effectively. I have done it in the past, but no, I kind of took that out of my trading method a long time ago. So not that it's not a good thing. There's a lot of good things that can be done, but again, to keep my mind clear and organized and focused and to avoid information overwhelm, I choose to only watch a few things, and I let other people play, you know, their things, and I trade mine. And for me, I just haven't found that the opening range, you know, is consistent as some of the other things that I do. But that's a good question, and because that is a common approach and can be used well. And here's another one that's come up a few times, so I'll answer this one to Carl, the last one who asked it. Do I use a choppiness indicator? I do not. I do not. Again, for me, the way I define a chaotic market is one when the five energies don't align. So I just assume, as I said, I think that the market is a random walk most of the time or in a chaotic state most of the time. So I don't need an indicator to tell me if it's choppy, because it's not even just choppy, it's more just unpredictable. So I assume that's the norm. and I'm waiting for order to come into the market. And when the 5 energies align, that's when there's order. So I'm just always assuming it's choppy. Okay, great. All right, well, it looks like most people are finding that the link is working now, so that's great. Good, good. All right, well, thank you, everybody. You've been great. Good questions, and sorry I wasn't able to get to all of them. Feel free to email at barry@topdogtrading.com, and I'll answer any others that come in. And thank you to Stephen, who couldn't be here today because he's traveling, but still, I appreciate him and everything that he does. He's amazing teacher. I just love him and love his stuff. Thank you, Becky, for being here and for hosting the webinar today. Great gratitude to everybody here today, and hope to be interacting with more of you soon.